Okay, good afternoon, everyone. Thank you very much for joining this panel on tokenization, where crypto and TradFi meet for finance's next leg up. I'm David Sephri. I run the equity sales team here in Hong Kong for Macquarie, and I'll be moderating this session. Today, we'll discuss why tokenization is reshaping finance by combining crypto's value transfer rails with the scale and trust of traditional finance, and what that convergence could mean for institutions and investors. I'm by no means an expert, but we do have two gentlemen over here that are terrific speakers on the subject. First, Allesio Quaglini is the CEO and co-founder of Hex Trust, a digital asset financial institution established in 2018. Hex Trust specializes in custody, staking, and market services with licenses across Hong Kong, Singapore, Dubai, and Italy, serving institutional clients globally. Allesio is also a member of the Hong Kong SAR government's task force on promoting Web3 development, contributing digital asset policy, and a leading regulatory hub. He brings over 15 years of experience across banking, regulation, and consulting, with previous roles at BBVA, First Abu Dhabi Bank, and Italy's securities regulator, Consob. And he holds a master's in engineering and MBA, and is a CFA charter holder. Second is Peter Chung. He's the head of research at Presto Research. Presto is a Singapore-based algorithmic trading and financial services firm that executes over 100 million trades daily across digital assets and traditional finance. Before Presto, Peter led the research team at Corbit, Korea's oldest crypto exchange, and he has over 20 years of capital market experience at firms including Goldman Sachs, UBS, Credit Suisse, and where I used to work with him at Nomura. He holds a Bachelor's of Science in Economics from the Wharton School of the University of Pennsylvania. So with that, let's get started. So this is obviously not going to be a crypto one-on-one, but at the same time, we have some people over here that are not native AI. But we obviously don't want to make it educational too much. But we'll keep the jargon low. If we must use a term, we should probably define it, I would imagine, and then move on. One of the main big picture questions I was thinking about looking to address is that for institutional investors, if they can buy Tesla stocks or a bond, why would they go to tokenized version? What are the differences that justify this kind of transition? This part is actually seldom explained to people like myself. People talk a lot about more liquidity, but can't justify it. They talk about fractionalization. We've seen it with Robinhood in America. So that's one of the main big picture things that I was looking to address here with you gentlemen. But I think going back to at least defining some of the stuff that we're going to use. So tokenization, according to what we put together, is a digital representation of an asset or a claim recorded on a ledger so it can move and settle more efficiently. Stablecoin is a token designed to track fiat value used as a settlement asset on chain, and fiat being traditional currencies like the dollar. Tokenized deposits, those are bank deposit money represented as tokens or bank liability aimed at regulated settlement efficiency. And then DeFi versus TradFi. Open programmable rails versus regulated balance sheets and distribution. So yeah, I just had to get that out of the way.
Can I make some
yes, of course.
there?
Sure.
So I think your definition of tokenization, you said it's a representation on ledger, right?
It's a digital representation of an asset or claim recorded on a ledger.
Yeah, can I maybe add one word there? Public ledger.
Okay.
Because in a TradFi, it's already on ledger, but it's a private, siloed, permission ledger.
Right.
Whereas blockchain is a public ledger where everybody has an access to.
Right.
And no one can shut it down. So that there's one big difference there.
Awesome.
Yeah.
Okay. Now that we've cleared that up, thank you.
Maybe I need to add that the ledger also needs to be distributed or decentralized.
Right. That's yeah. So all the characteristics that I mentioned is the characteristics of a decentralized network.
I'm beginning to realize a better moderator would have been Paul. Paul, for those who don't know, is our head of US tech research, and he's also very much involved in this subject. So let's go into the core discussion that I really wanted to get into. So why now is the first question. You know, like what's changed since the last cycle? You know, you got regulation, market infrastructure, institutional participation, settlement experimentation. So why now around tokenization? Maybe I'll give that first to Peter.
Yeah, why now? So I guess three things happened maybe over the last 3 years or so. One is just people. So this technology came into existence in 2009 when Bitcoin first arrived. And when the technology first arrived, people, I guess, couldn't quite wrap their heads around on where the real use cases are. So there has been various types of experimentations, try and error. And over the last few years, I think, you know, we, through the experiences and through a lot of failures, the market as a whole came to a better understanding of where the product market fit is. So, you know, another way of saying the market has matured. Industry participants have matured, and there are more players in the market that has more mature and better understanding of how this technology fits into the real world. A good example is, you know, people like Larry Fink at BlackRock, for instance, right? So that's one thing. And then, so second thing is, because I mentioned the, you know, it's a good segue. You know, the arrival of a spot crypto ETF, Bitcoin ETF. So spot Bitcoin ETF, you know, got listed on January 11th, 2024. I remember, I memorized the dates because it's very kind of a landmark event in my view. And as a result of it, I think it brought huge amount of legitimacy to the asset class and to the industry. And I think that also drew attention from a lot of so-called non-believers in TradFi space. So that's the second thing. And the last thing is, I would say, you know, crypto-friendly administration in the US. So because I think, you know, this technology started in the US, it kind of gels well with the value systems in the US, so-called, you know, freedom of money, you know, the decentralization, distribution of power, things like that. So I think US has been an opinion leader and a trend setter in the crypto industry. And so what happens in the government in that country, I think it matters a lot for crypto industry globally. And, you know, regardless of what you may think of a Trump, one of the things that I think this US government, the current US government has pursued aggressively is to bring more regulatory clarity to the industry so that the industry can grow. And that's what happened since 2025. And I think that's one of the main also triggers that have, you know, prompted this trend of more TradFi embracing the technology and tokenization and so forth.
Allesio, I want to give you a chance also to chime in.
Maybe just from a different angle, but more or less the same type of ideas. The movement was born as a tech movement, right? A cryptographic movement. Then it became more or less of a freedom of money type of movement. But the attention of the movement or the blockchain industry in the last 5 to 10 years has really been to basically bring fiduciary capital onto the blockchain, right? To attract institutional investors to be able to enter the industry. So the whole attention of the industry was to basically work towards what was required for institutions to enter the industry in different shapes and forms, not just by investing into companies, but bringing traditional assets onto the blockchain or buying assets that are native to the blockchain, like Bitcoin. So what happened is really we had, I would say, a first cycle of experimentation where we had people developing DeFi protocols, and at the same time, companies like, for example, Hextrust building the infrastructure that is necessary to connect capital to the blockchain and to the DeFi functionalities. Then after that, there was a second phase, the second cycle, which was really, all right, now we have the infrastructure, now we have all this kind of connectivity to the blockchains, we need to regulate it because there's too much money on it, right? And the regulation came. It came at different time and in different shapes and forms around the world, likely or unlikely. But obviously, still we have a lot of lack of harmony, I would say, across different jurisdictions. And then with regulation, basically came the most important part, which was bringing some types of instruments that allow fiduciary capital to flow into the industry. And the main example was obviously the ETF. So now that we have regulation, we have the infrastructure, then I would say now, you ask why now? Because now we can talk about use cases. That's really, without these two ingredients, it wouldn't be possible to really speak about use cases.
So let's expand on that a little bit on the use cases. But before that, I wanted to, you touched upon, both of you touched upon fiduciary assets coming on, which has enabled this trend. So have you seen that fiduciary flow of capital, kind of go up or go down with specific, things like, for example, the price of Bitcoin, or if you've seen, or if you look at, for example, just global assets in general and how they've behaved, especially this year, has that changed, or is it structurally still the same story?
I mean, we have these two trends, right? We have assets that are going on chain. So now we have, well, stable coins obviously are the first, I would say, tokenized version of an asset that is on chain. And Peter would know better, but we're probably at around 300 billion, right, of the stable coins circulating. We have money market funds, right, that came on chain, and we are at a couple of probably 20 billions or something. Now we have the tokenized stocks. We can talk about it, etc. And then on the other side, you have capital flowing into blockchain assets that are wrapped around kind of some financial wrappers that are investable by institutional investors, right? And we have the Bitcoin ETF as the first one. There's probably around $100 billion right now, and it's one of the fastest growing ETF in the history.
Peter, maybe on the use cases side, so can you sort of allude to, or at least point to anything that you found to be probably the most significant, or is it, a combination of many things? I mean, to a person of like myself, where I'm not obviously a crypto expert, but when I hear about Robinhood tokenizing assets and trading them globally at any time, anywhere, I mean, I could see the appeal, of course, but what's your view?
Yeah. So when you talk about use case, I like to maybe break it down to two things. So one is there's use case as a savings technology, as a store of value, and people often kind of don't like view it as a use case, but I think it is. And then good use case for that is actually Bitcoin as a savings technology, similar to how you want to hold on to your gold as a store of value. So that role Bitcoin has been playing, for a long time. And I think ETF has enabled greater access to the asset to fulfill that role. So, but putting that aside, because not people kind of tend not to think about it too much. The use case that I think you want to talk about, I think, is the tokenization, right? And tokenization is basically, I mean, you defined it at the beginning, but it's basically, it's a representation of an asset on a public blockchain. And by why the reason why you want to do that, why that's such a innovation, is because blockchain is a network where you can exchange values, anything of a value, without intermediaries. And when people hear this, what the hell does that mean? What it means is, so I want to maybe help you understand it with analogy to internet. So internet is another example of a decentralized network where information travels freely without intermediaries. So when you think about blockchain, you can just say replace the word information with a value. So it's an exchange, it's a rail where you can exchange values without intermediaries. And just like when you remove intermediaries for the information network, has brought a lot of benefits. For instance, ability to exchange information very cost efficiently, and that became a basis to build a lot of services to build on top of that. Similar thing can happen when you put value, anything of a value on the blockchain, because now value can travel freely without frictions. So, and then tokenization is also, you can think of it as an extension of a securitization. So what is a securitization? Well, securitization is, it started out, I would say, maybe in the 70s when banks, commercial banks decided to securitize or securitize their mortgage loans, because before that there was no way of offloading your these mortgage assets into another third party. But once you wrap it once you convert it into like a bond like instrument, suddenly you can trade it, and now you have a price discovery, and because you have a price discovery, you can use it as a collateral, and also investors have greater access. Investors have an access to these new type of investment assets that they didn't have otherwise before. So that's a securitization. But when you tokenize something, then it brings all the benefits of a securitization, but even on a more efficient rail, because as I mentioned, blockchain is a network, far more efficient network of that enables a value exchange, and that's why tokenization makes a lot of sense. So, sorry, just kind of, what is the original question? I don't know if I'm getting.
Actually, I think I forgot my original question, but
Yeah.
it's more about no, just what. So, what are the use cases that you think?
Oh yeah. So sorry, yeah. So the tokenization is a good use case because now you can put all these assets that people want globally that was otherwise not very easy to access. So, and a good example is a stablecoin, the US dollar stablecoin, right? US dollar is probably, it's the currency that everybody wants globally. Even, guys in North Korea, when they want to store their wealth, they want to store it in US dollars rather than, some other currency, even their own currency probably. And we see these kind of things, over and over in various other emerging markets where their own currency regime is very, very fragile. Yet, many countries actually restrict, especially these kind of, emerging markets where they don't want capital flight out of their own country. They limits access to US dollars. Go to places like Argentina or a lot of emerging markets in Africa or the Middle East. But once you put it on the blockchain, now everybody can access it. So that's the kind of the beauty of tokenization, and that's what good use case with the tokenization is US dollar stablecoin, and then now we're branching out from just a tokenizing fiat currency into other type of assets like money market fund or corporate the U.S. Treasury and now U.S. equity and even commodities. So yeah.
Allesio, I want to give you a chance also to elaborate on that if you wanted to.
Sure. So use cases, I think Peter said it right. I mean, we have obviously the investable, we have the these kind of assets that are kind of more fungible than in the traditional world. We need to think about anything in the world that has been built with geographical national silos. Right? So this kind of a use case, they apply very well to financial markets because every single country in the last 60 years, they've built their own systems as a silo, right? And these systems, they kind of work okay-ish within the country, but they work very badly when you connect them with other country systems. So you would notice that in Hong Kong, for example, we have PayMe, and in other countries we have payment applications for domestic payments, and they work very well, right? We don't really need a stable coin to replace those domestic systems that settle automatically. But the reason why PayMe settles automatically is because it's done within HSBC Ledger. The reason why FPS settles very well in Hong Kong is because it's done within the Hong Kong banking system, right? But when you need to connect something that is in Hong Kong with something that is in the US or in Korea and everything, that's where everything breaks, because you have siloed systems that barely communicate with very outdated systems such as Swift. Yeah? So that's, I think, where we need to really look for the use cases.
So I'm sure you, I don't know, but I would imagine you get this question when you think about how a government would look at this, right? And would they be warranted to be afraid of this, or should they embrace?
I'll just answer briefly on this. They will be very worried because for different reasons, right? Obviously, the US, because the main competitive advantage is the US dollar, right? So they want to be able to control exactly who can access the US dollar, who can spend it, and how it moves, and what are the rules around the movement of US dollar around the world. So obviously, that's why the US are so concerned about stable coins, because they run on a public ledger, and it's not them who can decide which transactions will be blocked and which transactions will not be blocked. But it's not only the US. The equities market is usually the crown jewel of every single government, right? They want to protect it, and they want to make sure that the access to that market, the fees, the commissions, who gets accepted and who doesn't get accepted, is controlled by the government or by the national exchange itself. Right, so when you put it on the blockchain and everybody can issue an asset, everybody can access your retail market, your public, without any control, that's an area of great concern for government.
Yeah. So should government be concerned? You're right. I think if you're a government that has a lousy monetary or fiscal policy, then you should be worried. Yeah. And usually, up until now, these governments, the way they try to protect themselves or hide behind their lousy policies or by putting capital control. And so I think these countries should be worried. The way to overcome, this technology becoming a threat to them is basically by getting their acts together, I think. So basically, come up with a better, monetary or fiscal policy, and that way, you won't, you won't experience this huge capital flight when, this technology actually, arrives in full force. So I want to actually mention an example of UK government. A lot of people think that obviously British pounds is a free currency. There's no restrictions and everything, but it wasn't always like that, believe it or not. So in the World War II, they imposed capital control because national emergency, right? Maybe 1941, something like that. And then even after the war ended, they maintained it because the economy was in shambles and had to be rebuilt. And only in 1979, when Margaret Thatcher became a prime minister, they got rid of it. And what she said during that, when she made that announcement, I forgot the exact wording, but she said something like, capital control is no longer, necessary kind of a policy for them because currency stabilization is achieved not by limiting free movement of currency, but by, by running a sound fiscal and monetary policy, something like that. You can look it up, the exact wording. So I think that's the right approach. Any government, mature government, with experienced policymakers, should be able to run their currency regime without, imposing these capital controls. And only those who are not maybe capable or unsure or whatever, they tend to maintain. These are the ones that tend to maintain capital control. So I think maybe given enough time, I think capital control is going to be a kind of obsolete concept.
Actually, so on that note, because we had our our global equity strategist earlier this morning talking about that specific subject with regards to China. So China, obviously, it's got what he's saying is it's got a liquidity trap, and the only thing that's preventing it from becoming another Japan is the fact that it's hiding behind the capital controls. China and the digital currency initiative that they've put forward, how has that developed? Does it look like, tokenization is going to have an impact on them? Should they be worried? Is there a way for them to prevent it from happening or control it, or do you think they embrace it?
Yeah. So specifically about China, right?
Specifically
so,
China.
I mean, I'm sure they have a lot of smart people probably thinking about this, but I think, China had for a long time they had a plan to internationalize renminbi. I'm sure people know about that. But I think they've been wanting to take it slowly, right? But I think the way to kind of deal with this blockchain technology, if I was a policymaker, would be just like what I said earlier, is make their renminbi denominated assets more attractive. So when that capital control is lifted, there will be more inflow of capital into the country rather than outflow. And actually, many developed markets, that's how they run their currency regime. The US, UK, many of the European countries, Japan, even Hong Kong, right? Hong Kong, Singapore. These are the markets that MSCI define as developed markets, right? Because of their free access to the global investors. So I think it's China can definitely with the right kind of maybe not overnight, but gradually. That's the type of I think state they want to arrive at before before stablecoin, US dollar stablecoin becomes more widely adopted in the world. Because as it gets more widely adopted, it's going to be so easy for anyone in China to access US dollars. All you need is just download Web3 wallet and then receive US dollar stablecoins.
Allesio, did you want to add on to that? Because I've got the next question for you. Right. I'm taking a step back. I want to go back to the infrastructure element of everything. What do we need in that regard? What are the institutional players needed to support it? What are the protocols? So everyone uses Ethereum and Solana. Is that going to cut it for institutional investors, in your opinion?
So I was mentioning that in the previously in the previous question that the infrastructure has been built. Well, it has been built, but we're not really at a state that is kind of we have a perfect infrastructure for institutional investors. For the time being, we had the experiment of private chains. We've seen it with Corda, etc. They didn't work. Why? I mean, Peter was mentioning because they are private ledgers, right? So if they're private ledgers, there's no reason why you would not use your own Excel sheet or your own ledger, right? You don't need a blockchain. And now we had the experiment of the cycle of public chains. So we had the Bitcoin, we had Ethereum, Solana. They improved drastically, right? So Bitcoin took 10 minutes or something to settle, right? Ethereum, a couple of minutes, right? Solana, a few seconds. So there has been a kind of a technical improvement in speed, finality, etc. But these chains are still public chains, right? So they have lots of limitations, lots of advantages, lots of limitations. They're public, observable, etc. They're not bound to a country. They're not bound to a group of banks, etc. But at the same time, everything is public. So every transaction that you do on the chain is seen by everybody. And it's true that you cannot directly connect it to a name or an account number, but you can actually do it with forensic investigations, right? So it means that everybody would know if somebody's buying a stock. And front running, by the way, in the blockchain world is something that happens normally because transactions are public. So there are bots, there are AI agents that do front running on it continuously, right? This creates efficiency in the market, but doesn't really work for institutional investors. Yeah? So we do need some kind of upgrades to the technology today. And I think the two paths forward, in my opinion, are going to be the first possibility is basically building functionalities on top of the public chains. Lots of people are working on them. We're talking about functionalities around compliance, talking about functionalities around governance. For example, who decides whether a transaction needs to be rolled back? It can, in today's world, 99% of the transactions in stablecoins are in USDT. USDT is controlled by two guys in Switzerland, right? This cannot be, it requires a governance upgrade. And privacy. Privacy, again, we need to be able to basically show a trace of the transaction on chain, but not the full details. So these are the upgrades for the public chains. The other possible path is basically having purpose-built chains that kind of collect the requirements of institutional investors. Some people have done it, and they've created chains that are both public and private at the same time. They're hybrid. They have some kind of public settlement, but at the same time, they have private privacy features, right? An example, which is one of the chains that has been invested by lots of institutional investors, including the DTCC, is the Canton network, right? Which is basically the coordination of different private chains that use the same public settlement ledger, right? So these things are possible, and I think we will see exactly this two trajectory, right? We'll see the public chains upgrading and bringing functionalities, and purpose-built hybrid chains entering the market. Now, for example, nobody would know which ones will be the winners, and it's not really our job. The job of a kind of infrastructure company like Xtrust is actually to give access to both possibilities for institutional investors, and not only that, but to create the compatibility and connectivity between these two different chains.
Yeah. Or did you want?
No, yeah, it's just only thing that I would add to that is that you know, the interesting trend that we've been seeing in the maybe last couple of years with all the TradFi participation in the space is you know, the compromise of the blockchains, the qualities that I mentioned earlier, you know, like the so-called the permissionlessness, which is basically you know, open access to anyone can approach it, and then the censorship resistance, which is, you know, it can never be shut down. These two qualities actually, I think, unfettered the qualities of this blockchain. The public blockchain was actually somewhat of a hindrance to the institutional adoption. So I think there's some compromised version of that coming out, and that's been quite successful in promoting institutional participation. And one example of that, I think, is you know, as Allesio mentioned, there was, you know, the Canton network is one of the, you know, one of such networks which have seen a, you know, huge success in the recent months. So I think maybe that type of this is a sign that you know, that I like to point as a sign of a maturity in the industry is you know, a lot of like ideologies were, yeah, fine and all that, but like when it comes to actually making it useful in the real world, sometimes you need to compromise a little bit on these qualities, and you know, I think that's been quite successful in recent months.
So one thing that sort of came through my mind as you guys were both talking was around when you look at the infrastructure value chain needed to make this happen, there's some parts of that that's going to be more efficient than others, or more available, or easier just to implement. What are the parts of that where you think it's easier, or where it's more difficult, or where you find that there's issues that still need to be addressed, or where you find that maybe government is blocking things, or yeah.
Yeah, I mean, so I think what the government can do is foremost just providing regulatory clarity and become more proactive in rulemaking, so that industry players can figure out and make plans rather than left in the dark and don't know what to do. So you know, that's the reason why I said that under this administration in the U.S. at least, you know, we've seen huge improvement in terms of regulatory clarity coming out, and that's the role that government, you know, can play. I mean, but in terms of other things like, you know, the privacy is important for institutional clients, and therefore, you know, there is the recent blockchains in try to kind of embrace that feature, and also, you know, being able to do KYC and AML type of you know, perform these functions also became important. That's why we start to have more like a permission approach with this network. I think all these things I think industry can figure it out, because I think industry is not, it's a lot more mature. So they know that you know, these features of a TradFi exist for reasons, and needs to kind of embrace some of that onto how these infrastructure are designed, and that's happening. So that's a good news. But obviously more work needs to be done. But I think as long as the TradFi and you know, the crypto industry kind of work together to hammer out the technical solutions for that, I think you know, the industry is moving in the right direction.
Right. Allesio, you're obviously, this is your core niche, so I wanted to give you also an opportunity to sort of talk about that as well.
Yeah, but I mean, I think the main issues in the blockchain world is still more or less the same. We have the counterparty risk. So we have basically lots of players that operate, let's say, a banking business or a brokerage business, and widely unregulated. Right? We have most of the stable coins still in the industry that are unregulated, right? I mean, USDT, again, is unregulated, 70% market share. And then we have this big threat that is becoming more and more evident, which is basically the vulnerability of DeFi. With AI agents basically being able to scan in real time public open source code of DeFi protocols, it became basically extremely easy to find vulnerabilities in real time and build thousands and millions of AI agents to exploit these vulnerabilities and extract money from the contracts. So now the industry is building AI agents to defend this public, this kind of assets, and to assess the vulnerabilities as a defense mechanism. But I think this kind of having open source code on chain available to everybody with the in an era of AI is really going to be something to look at.
For the audience, by the way, if you want to ask a question, there's the Slido. You can just scan the QR code. I think it's up there, and it'll show up over here. I accidentally pressed on the first question that I got, but I still remember it. It's about the U.S. seizing some digital assets recently, claiming that they were from criminals or something around that nature. What are your comments around that, Peter? You seem eager to answer that question.
Well, these are bad guys, right? So I don't know exactly which kind of seizure it was. I mean, there's a lot of opinions out there, like, you know, with their, you know, I think maybe the person who asked that question was referring to the recent hacking incidents where
Yes.
And I think so. My view is that as long as the network participant agrees that the asset needs to be seized, I think it's, you know, I mean, I don't see a problem with that. And but I'm not everybody agrees with me in the industry. Some people think that you know, it's a public network. You know, no one should be able to control how the asset moves around in the, you know, on the blockchain, and, you know, maybe they should just leave it alone. So, you know, I mean, I respect that opinion also. But if you were to ask me, yeah, I would say that as long as there's network belongs to the users, and there's enough users agree that certain asset needs to be seized, I don't see much problem with it.
Allesio, I wanted to. There's a question here on you as a crypto founder. What are the challenges Hex Trust faces when trying to differentiate from other industry participants?
I think the financial industry in the blockchain is nothing very different from the traditional financial industry. We do the same things. We do custody, we do markets activities, we do lending and borrowing, etc. But in the past 10 years, there's been quite a bit of funding coming into the market, which means that the industry has been quite oversupplied. And for every single activity, there have been lots of players operating unsustainable business models, right? So to me, the only thing I can care about is to basically create value for the clients and operate a sustainable business model that makes money and that can rely on its own resources without having to rely on external funding from investors. For the rest, I think the technological specialization, especially in an era of AI, is much less important than before, right? All these new technologies that we implemented for wallet technology, trading technology, platforms, etc., are not going to be a huge differentiator. People can copy everybody else's technology quite easily in today's world. So I would say it's more really about the customer experience and the kind of the value that you deliver to them in terms of quality of services and services themselves. In the last 12 months, we've seen a lot of consolidation, right? Both within the industry, kind of bigger players acquiring smaller players. We've seen consolidation in the same industry across different parts of the supply chain. So basically creating the whole vertical integration. And I mean, most of the players, the large players in today's world, are basically one-stop shop solutions, right? They offer all the services. But there's also been lots of intervention from outside the industry. So traditional financial institutions and similar investing or acquiring companies in the space. So this is happening, and I think the trend is really accelerating.
Peter, I want to give you a chance also to talk a little bit about the work that you're doing at Presto as well. So maybe if you can you discuss some of the business opportunities that you're seeing in TradFi crypto intersection?
Yeah, so maybe I should have mentioned this at the beginning, but so Presto, the firm that I work for, is a quant trading firm. And the quant trading firm, there's a decent number of quant trading firms in the space adding value to the development of the ecosystem. And one of the things we do is, provide a liquidity through various market-making trading strategies. And one opportunity that we see in the space at the moment is, a lot of TradFi firms are, having kind of a, recognition or realization that the blockchain is something they need to embrace in order to stay competitive. Similar to how, basically, to me, it's a question of whether it's a Netflix or the blockbuster moment. Like, if you're a media company and you're faced with this new technology called internet, some people recognize its importance and decided to go the way of a Netflix, but somebody like a blockbuster never realized its importance and then didn't do anything, and what happened to them. So I think many financial, no, I wouldn't say many, but quite a forward-thinking financial firms are recognizing this, and they are trying to incorporate some crypto or blockchain-related services into their existing business. BlackRock being one of them, one of the examples. But there are many more. The likes of E-Trade have started to offer crypto trading. There are many others. So, and I think the more and more of those companies realize they need to integrate blockchain into their services, they will look for some sort of a quick turnkey infrastructure solution that can help them launch a new service, some sort of a back-end solution. And that's where we see a lot of opportunities. And one of the things we're working on right now is come up with sort of these type of crypto infrastructure as a service, where people can maybe subscribe or just plug into our platform, and then they get both the blockchain backend solution as well as liquidity, which is something that we do well. And then that way they can quickly launch whatever the crypto related service they want to launch. So we're in the process of maybe building this type of crypto infrastructure as a service kind of platform. And if any of you here are thinking about embracing or incorporating blockchain into your services, please come and talk to me.
We have a few minutes left. What I want to do is just sort of give you both a chance to sort of give us, one next 12 to 24 months prediction, high level stuff. Maybe we'll start with Allesio, and I do have a question from the audience which I want to ask, but it's more about whether tokenization story is another NFT. But don't know if you guys want to address that first, or should we go into 12 to 24 months?
Maybe that one first.
Okay.
I think the tokenization for the industry, for finance, is the same thing as kind of the containers for the shipping industry, right? It's a standardization. Bringing the container in 1968 to the shipping industry brought the cost down from $6 to 16 cents per ton, the handling time from 3 weeks to 1 day, and completely reshaped the industry. Why? Because you had one standard 28.8 kind of feet container that could fit all the ships and could be handled by the same rails and handling facilities in every port around the world. The goods were the same inside the containers, still grain, still barley, still furniture, but they were wrapped inside a standard container, right? So that's really tokenization, right? That's really what the blockchain does. It creates the same financial infrastructure for the whole world. And all of a sudden, instead of taking 3 to 5 days or a question mark number of days to move up financial assets around the world, it takes 10 cents of a dollar and a few seconds to move US dollars in the same way that you would move a Tesla stock that in today's world in finance is not movable across different custodians or different brokers. So that's the real revolution. It's standardization, which in the blockchain we call fungibility of assets. And I don't think this is the same thing as kind of selling apes pictures as an NFT on platforms. Yeah, this is a very different structural revolution.
Yeah, I mean, I completely agree. So tokenization is just better plumbing for the financial system. The basic components of a financial service is liquidity aggregation or pooling of capital. Only then you can, you can provide services on top of that. Banks taking deposit of is capital, or liquidity aggregation, and only then you can make lendings. So it's a basic components of any kinds of financial services, and blockchain is simply a just better plumbing, more efficient way of pooling capital, because it's a lot easier to, and simpler and cost effective to move capital around when it's on top of blockchain rather than on traditional banking rail. So calling the tokenization a bubble would be like calling internet a bubble. I mean, it's a technology that's going to be around with us for a very long time.
Do we want to go very quickly? We only got 2 minutes. 12 to 24 months predictions.
So maybe super quickly. I think since the AI topic is very hot, right? Hotter than crypto nowadays. Maybe the prediction is really that AI is already using the blockchain and will be using blockchain more and more, not just for hacking into DeFi protocols, but really as a way of moving money, value, etc. AI agents, they cannot open bank accounts, they cannot use credit cards for payments. They are already using wallets, they're already using stable coins, Bitcoin, etc. And they move assets very quickly. And this trend is only going to accelerate.
Peter?
Yeah, I would say that a lot of equities going to be traded on blockchain. Maybe, it would be more interesting to put a number to it, but I don't know what's the good way of doing it. But like, I'll share an example. Like a New York Stock Exchange, for instance, it's public information. They launched the tokenization platform. They plan to launch tokenization platform before the end of the year, where they're going to tokenize all the stocks in Russell 1000 index, and plus maybe even some more. And last night there was a news that the SEC is likely to announce sometime this week an exemption for so-called the third-party equity tokenized equities. And without getting into the details, basically, what that does is it opens up the whole, it enables tokenization process far easier than before. And so, if you invite me back next year, I'm sure we're gonna be talking about, you're gonna I think all of you here are equity investors, so you're gonna be talking about being able to access a lot of stocks that you were not previously accessed before because of the pre-IPO, and it was not easy to trade them, but it will become a lot easier to trade them in future, and that's the type of stuff I think we're going to be talking about.
Very interesting. Thank you very much, gentlemen, for your valuable insights. Always a pleasure. Thank you so much.